Okay, so welcome everybody to the Forex Masterclass, the professional's approach to trading. What we're going to do throughout this course here is basically take you through from the very beginning, so the very foundations of the FX markets all the way through to trading advanced strategies and different strategies as well. So what we're not going to do in this course is just give you the one strategy that will work during one market condition, okay, because that's not going to help you in the long run. So we're going to give you an arsenal of different trading approaches that you can apply to every different type of market condition. Now it may be that in the beginning you have an affinity to one particular strategy. You might prefer trend trading strategies, you might prefer shorter term strategies, and that's fine. You can become a master of those strategies in the beginning, but you just need to be aware that for longer term success, in the FX markets, in trading, you need to be quite adaptable. All right, so you need to be able to utilize all of the strategies that we're going to show you throughout this course here. Otherwise, you'll either get into a situation where you're trading a strategy that doesn't suit the market conditions. So all of the money that you make during a trending market, for example, if you try and apply that same strategy during a consolidating market, you're then going to come unstuck and you'll lose money. If you are able to identify the market condition, which you should be able to after this course here, and you decide that during those conditions that you just won't trade, well, you won't lose money, but you won't be making money either. Okay, so you have to see the importance of being able to maintain multiple different strategies. And as I said, even if that means in the very beginning, you don't apply all of them, you just become a master of one of the strategies, that's absolutely fine. But just keep in mind that the end game has to be trading, different strategies, different time frames, and sometimes even different asset classes. So, you might want to branch out and utilize what we're showing you here in the stock markets and the commodities markets, etc., etc. Okay, but this course here is obviously specifically focused to FX. So, moving on. So, what we're going to cover during the weekend more specifically, let me take a step back a minute and just give you the normal disclaimer here. So the disclaimer is obviously that the content of this course is for educational purposes only. All right. Everything that we show you here we'll show you what we do with our own accounts. We'll show you our own analysis, as we're going to show you at the end of the course. But everything that we show you is for educational purposes only. The content of this webinar may not be suitable for everybody. You obviously have to decide for yourself whether the things that you see here are things that you want to apply within the markets or not. Okay, now that we've got that over and done with, what we're going to cover this weekend, all right? We're going to cover the foundations of trading. All right, so we're going to go from the very beginning to the very end. As I said to you, we're going to cover, what is the FX market? What does the FX market do? Who are the players in the FX markets? Because this is extremely important to your success as a trader. We're then going to cover Forex fundamentals and themes. And I know that many of you that are watching this are going to sit there and say, oh, no, Forex fundamentals. I don't care about that. I only want to look at charts, and that's absolutely fine. But for your long-term success, all right, if you want to be getting into the trades that make complete sense and make you money a lot more often than not, then taking into account some of the fundamentals and the themes is going to help you a lot. It's also going to give you a heads up on where certain markets are heading. One of the questions that we get asked a lot by our members, by people that contact us through the contact forms are there any sort of leading are there any correlations in the market? So can I look at something specific and that will tell me what's going to happen for a specific currency pair? And absolutely there is. And we're going to cover that there as well. We're then going to talk about core technical analysis. All right. And you might be sitting there thinking, well, what on earth is core technical analysis? Core technical analysis are the main aspects of technical analysis that you need. We're not going to try and dress this up with 40 million different indicators. We don't need this to be the most complicated approach to trading that there is. It just needs to be the most effective. which it is. So we're going to show you what you need to be able to make money in the markets. We're not going to cover, every different indicator there exists to mankind, because that's not going to help you make money. The purpose of this course here is to get you in a position where you're going to be able to make money. We're then going to show you different strategies, all right, different entries and exits for different types of market conditions. We're going to talk about risk management. But not just risk management from a perspective of how do you save your account, but also how do you grow your account as well. Because risk management is a double-edged sword. It's not just about protecting the downside, which you have to do, by the way. You have to have enough money in your account tomorrow to be able to take the next setup and the next trade. But on the other side of the coin, you can't be trading so small that you're not really going to make any money. All right, so we need to get that balance correct. We'll then be talking about professional trading. Okay, so how do you make this, more of a career, as opposed to just a hobby? Because we all know that as hobbies, the way that you approach a hobby is that you spend lots of money on it. It doesn't really pay you money. So if you treat trading as a hobby, it's going to pay you like it's a hobby. You don't want to do that. You want to make money. And that's what we're going to teach you this weekend. And then finally, we're going to cover our 2016 outlook. So what are some of the major themes that we're looking at taking advantage of this year? And that goes back to the Forex fundamentals and themes at the beginning there. We're going to cover what, in our opinion, the market's going to do in the next 3 months, the next 6 months, the next 12 months. And then you can position yourself accordingly to take advantage of those setups when they present themselves. So, beginning with the Forex market, what is it? What is it that we're trading here? Well, the Forex market is the largest and the most liquid market in the world. It's got an average daily volume of $4 trillion, and I think that might even be a little bit more now. The uniqueness about this particular market is that there's no central exchange. So you don't have one place. Like if you were trading a stock, for example, there's one source of the truth for the price. There's no central exchange. What you have is a number of different banks competing for liquidity, providing the liquidity to the market. So you get competitive prices, but there's not one single correct price. So many of you will find that with your different brokers, you might be looking at euro dollar at 1.0621, and your colleague might be looking at it at 1.0623, for example. All right, so the prices there can be a little bit different. You've also got a variety of different participants within the FX markets, all right? And they've all got different reasons for being there. And believe it or not, it's not all profits. So not all of the participants there are there with a profit motive, all right? This is in no particular order, rather. One of the participants are the corporations. Okay, so the corporations will use FX to facilitate trade. So for example, if you imagine some of the big car manufacturers, all right, if they're doing business overseas outside of their own country, if you like, they will need to exchange currency to be able to do business in the countries that they want to do business in. And then when they want to bring their profits back to the headquarters, to the corporation, they then need to repatriate their funds. And that there is going to be an FX transaction, right? But there's not necessarily a profit motive there. They might use the FX markets to hedge some of their currency risk and things like that. But something as simple as bringing your profit back into your country, all right, there isn't any profit motive, all right? And they're going to do it just because they need to do that as a part of their business. And some of them, all right, that are large enough will actually move the markets a little bit based on them repatriating their funds. Okay, so you need to take this into account. So sometimes you will be in trades which go against you for no particular reason. There's no fundamental reason against it. The market just starts to trade against you. And oftentimes this is what that can be about. You then have the major banks who make up the interbank market, all right? And yes, they will be trading, but for a lot of it, they'll be providing liquidity. You've then got speculators, all right, that want to profit from inherent volatility. So you got the speculators like, the big hedge funds, Even the retail markets are making up a good proportion of this now. It didn't used to be the case, but nowadays you're getting more and more retail traders taking part in the FX market, so they're becoming a bigger percentage of that market. All right, so speculators are people that are in the markets to make a profit, to make money. And then you have the governments who invest in foreign exchange reserves, okay, and they also use the FX markets to manage their economies and things like this, okay? Because if you think about it, just logically for a minute, if your currency is particularly overvalued, it makes your exports, the things that you export out of your country, less attractive to the rest of the world, which will then affect your economy. So you will find certain central banks, right, will participate, let's say, in the FX markets. Bank of Japan have a history of intervening. All right, when the yen gets a little bit overvalued, they have a history of getting involved to decrease the value of the yen. Just last year, you had the Swiss National Bank, okay, who put a floor under the euro at 1.200, so they were artificially propping it up, okay, to that level there. They removed the floor from the markets. So there are massive repercussions that occur as a result of central banks getting involved in the FX markets. And it's just good to have an idea that this exists, because it can keep you out of those situations where you get into trades that are particularly risky. Nikki and I were not trading Euro franc last year. Why? We didn't think it had much upside potential. Okay, and we're always mindful of the fact that if there's a central bank intervening in the markets, there's always going to be some day that they turn around and say, actually, we're not going to do this anymore. Even though going back to that particular time, we think that it was a little bit wrong the way that was handled, because they actually came out that week to say that they were going to continue to defend the level. Then later on in the week, they removed that floor. Okay, and lots of people lost a lot of money during that time. So it was a little bit irresponsible in that respect, but we aren't central bankers, so who are we to comment on that? But having an appreciation for this will keep you out of trades that have a high level of risk associated with it. The FX markets, they're open 24 hours a day, 5 days a week. All right, there are three main trading arenas. So you've got Japan, Tokyo, Asia. You've got London, and you've got New York. All right, obviously within those regions you have Europe and Frankfurt, but they're the three main arenas that you pay attention to. The majority of the activity, all right, the volatility takes place during the London and the New York sessions. So between about 8 o'clock in the morning to 4 p.m. in the afternoon is where you're going to see the majority of the volatility, the big moves and things like that. Having said that, if you're trading some of the Asian currencies, so the yen, for example, if you trade the Australian dollar, sometimes you will see more movement in those currencies during the Asian session as opposed to the European session. FX is, and I'm sorry if I'm teaching some of you watching this to suck eggs here, but we just need to make sure we cover the basics. They're traded in pairs. All right, in the FX market. So ultimately, you're trading one economy against another economy. All right, that's sort of what you're making your decision on a very, very basic level. Now, of course, there are other factors involved. All right, but from a very, very basic level, you're saying, I'm going to trade the dollar versus the yen, okay, or I'm going to trade the pound versus the dollar, or the euro versus the pound, etc., etc. So you're taking a view on not just one currency when you enter a currency trade. You're taking a view on two separate currencies and two separate economies. And it's good to have that in mind, because a lot of the time, people don't take this into account. In the retail market, they're like, okay, I'm trading pound dollar. And they trade it as if it's just one particular instrument, which on the surface of it is. But actually, you've got two competing economies there, two competing countries, right, that can have an impact on the outcome of your trade. So, for example, you don't want to be getting into a position in, let's say, the pound dollar, saying, I think the pound is going to appreciate. It's going to get really, really strong, and not take into account what might be happening in the US. Okay? In these currency pairs, the first currency in the pair is the base currency. Okay, so euro dollar, euro is the base currency. Dollar yen, the dollar is the base currency. And the second currency in the pair is the quote currency. All right, so in the euro dollar, the dollar is the quote currency. Dollar yen, the yen is the quote currency. All right, so if we were to take the euro dollar, for example, and imagine that we were trading back 18 months ago when the price was at 1.2700. What that means, if the euro dollar equals 1.2700, that means that for every euro, you can buy $1.27. Okay? Now, as traders, we use financial charts to help give us context around our trades and to help us identify entry and exit points. All right, the chart can tell you a story which can lead to trading opportunities, but it must be understood that the charts are just one tool in a trader's arsenal. Just one tool. You can be successful using just this one tool. Absolutely, you can be successful trading just the chart, but for longer term success, you will want to be taking into account things like the fundamentals, the major themes in the market, okay? And we're going to talk to you about that during the course of this course here. Okay, so I know that some of you will be switching off when we talk about Forex fundamentals, but I urge you, please pay attention. It's only a short part of this course, all right? We can spend a lot more time on it. All right, but it's only going to be a short part of this course. If you're then interested in learning more about the fundamentals, we can point you in the right direction for doing that. Okay, but what we're going to show you here are kind of like the key concepts that you'll want to have a handle on. And even understanding those key concepts, that will put you on the right side of the market the majority of the time. If you then combine that with the technicals, you're going to put yourself in a great position to make money in the long run. And that's what this is all about. Now, there are different approaches, as I just said, to analysis and to trading. You have something called technical analysis, okay, which is basically looking at charts, taking your trading opportunities, identifying your trading opportunities from a chart. So looking at price behavior. There's a common sort of perception that the chart tells you everything that you need to know about the price. And for some people, absolutely it does. Okay, you can react to price action. You can react to the psychology of the markets by looking at the technicals, and that's absolutely fine. But there is another form of analysis, and that is fundamental analysis. Okay, and fundamental traders focus on the economic and theme-based drivers of the markets. Okay, so fundamental traders are more looking at anticipating what's going to happen in the coming months or years. Okay, and then you can use a technical chart for entry. All right, so you've got technical traders, you've got fundamental traders. What I'd like everybody on here to be is a combination of the two. So you use the fundamentals to try and derive some sort of a view on where the market's going, and then you use your technicals to really sort of nail down your entries. Okay? Now, there is no right or wrong way. As I said, you can be successful whether you trade just the fundamentals or just the technicals. You can be successful in both. But if you use a combination of both, you're going to be more successful. You're going to be more consistent. And as retail traders, that word, consistency, is so very important because there are very, very few human beings in the world that can trade a system where when they're right, they make 10 times what they risk when they're wrong. But they're only right 2 times out of 10. There are very few traders on the planet that can trade that way. So everything that we do with our trading is to build up a consistent approach. All right? Consistent results. An expectation of what you can get from your trading. Okay, so does that make sense to everybody? Are there any questions on what we've covered so far? All good. Where do you enter? Oh, Vittorio. You had me worried there for a moment. What can you do to avoid central bank interventions? You can not trade within those currency pairs. Okay, is the first thing. You can pay attention a little bit to what's going on within the markets. Look at some of the fundamentals that we're about to show you here, but ultimately, the only way that you can avoid central bank intervention, Stuart, is to not be involved in a particular currency that is sort of, what's the word for it? That's participating actively in the markets. All right, and there are a few central banks that are known for doing this more than others. We aren't at the moment, Stuart, but we were for the longest period of time. I mean, trading some of the franc pairs, the Swiss franc pairs, are not ones that we take a lot of. Okay, but we don't steer clear of them altogether anymore. But for the first quarter of last year, margin requirements went up and things like that, so we didn't really take many franc trades at all. Are there any other questions?